This Chapter 2 examines in detail the quantitative scoring factors applied by Moody's in their approach to the retail sector and how these are ultimately bundled together to derive a first estimate of the issuer's credit rating. The Moody's 1 document identifies 4 broad rating factors that drive the quantitative part of its retail industry assessment. These are broken down into a further 9 subfactors that each carries a specified weighting in the scoring process. The 4 key risk factors are business and cash flow volatility, market presence, execution ability, and financial ratios. And these are further broken down as follows. Within business and cash flow volatility, segment vulnerability to changes in consumer demand represents this entire category and carries a weighting of 10%, which becomes, of course, the weighting for the entire category. Within market presence, Moody specifies first scale measured by revenues, attributing to it a weighting of 10%, then market concentration and companies' presence in that product category with a weighting of 10% again, and finally company geographic presence with a weighting of 5%. These aggregate to 25%. Under execution ability, quality of execution receives a weighting of 10% versus 5% for efficiency, defined as EBIT to average book capitalization net of cash, which brings the total for this category to 15%. The financial ratios category finally represents 50% of the total weight, with debt to EBITDA at 15%, retained cash flow to net debt at 15%, and EBITDA to interest at 20%. We now turn to the determination of the rating earned by the issuer in each subcategory. Regarding business and cash flow volatility, Moody's uses this factor to measure risk on a segment basis rather than on an individual retailer basis. The thinking being that much of a retailer's revenue and cash flow volatility are a direct result of the segment in which the retailer operates, e.g., supermarkets, department stores, drugstores, etc., and of the products it sells, and are disassociated from the retailer's specific financial strategy. Revenue and cash flow volatility is particularly important given the significant fixed operating costs, potentially meaningful seasonal variations in working capital inherent in the business, and easy pricing comparability on the part of customers, which leads to significant price competition. For Moody's, this measure captures the expected vulnerability of revenues and cash flows to economic cycles, fashion risk and/or product renewal, and the rising or falling relevance of an entire business concept resulting from changes in consumer preferences or from macro issues such as technology or regulatory shifts. Recognizing that the retail industry as a whole is inherently seasonal, Moody's nonetheless differentiates between segments with high seasonality, such as toys, and those with less of it, such as food and drugs. Moody's considers 3 particular dimensions which affect consumer demand. 1. Changes in consumer demand due to fashion/product renewal risk or economic cycles. Retailers of low-priced consumables are expected to have lower cyclicality than those focusing on fashion apparel, for example. Specific product variables may also cause a retailer's performance to be disengaged from general economic trends because of specific product variables. Examples include retailers of electronics whose new product introductions can make sales spike even during an economic downturn, and on the opposite side, apparel retailers who can suffer inventory markdowns even during a boom because of a failure to predict the mood of consumers. The second dimension is the performance of the segment itself relative to other retail segments, and how demand within a segment shifts. Moody's illustrates this by pointing out that while demand for food generally has little volatility, the entire traditional supermarket segment in the United States has lost share to discounters and warehouse clubs, which have become more significant players. Third and last is product breadth, with retailers that offer a wide breadth of product options scoring higher, whether by offering multiple product categories or giving customers the option of trading up or down in price within a category. The table appearing now classifies the issuer's business and cash flow volatility into one of 8 broad rating categories, from AAA to CA, based on qualitative considerations such as vulnerability to change in consumer demand, range of low-priced consumer necessities, predictability of product demand and effect thereon of economic and product renewal cycles, and exposure to fashion risk. We will pause here for a minute while we examine the individual entries in this table. We remind you that only the broad rating grades are used for this purpose, as with all Moody's methodologies, i.e. with no specification of the usual suffixes 1, 2, and 3. Moody's also provides the following table, which lays out the typical degree of product volatility for the principal segments of the retail industry. Note the clear hierarchy in diminishing degrees of demand stability, from discounters and drugstores to supermarkets, convenience stores and appliances, to home and office supplies, toys and discount apparel, to specialty apparel, to retailers, luxury retailers, none of which should be controversial. We remind you next that Moody's associates with each subcategory rating a numerical value based on the grid appearing now, where you will recall that a high rating translates into a low numeric and vice versa. Our remaining task before we proceed to this final calculation is to summarize the scoring methodology for each of the 8 remaining subfactors on our original list. We turn now to the second rating factor, market presence, which you will recall includes 3 subfactors. Scale, defined to mean revenues in US dollars, market concentration and company's presence in that product category, and finally, company geographic presence. Retailers pursue size in order to gain procurement benefits from suppliers that create a competitive advantage through lower prices for customers and improved product margins. Also, the larger the company scale, the better it is able to leverage its fixed operating expenses and spread central costs across a larger revenue base, which enhances operating margins and return on investment. Scale, according to Moody's, is also indicative of the strength of a franchise as a proxy for the strength of the brand and the loyalty of customers, and better operating control in terms of its distribution network, supply, and distribution infrastructure, and often more robust internal reporting and control systems. The table appearing now associates a broad rating category with the entity's scale measured simply via its annual revenues in US dollars, and should be self-explanatory. You will note that while giants like Walmart and Carrefour can reach very high sub-factor ratings in this category, the great majority of local retailers in many countries will be hard pushed to rise above the CAA category rating, given the $1.5 billion minimum revenue requirement. The second subfactor, market concentration and company's presence in that product category, aims to capture the competitiveness of the retail environment in which the company operates by examining two qualitative and judgmental criteria. One, the market dominance of a retailer compared to peers that offer a similar product category, and two, the degree of market concentration. Noting that a consumer, for example, can purchase groceries at traditional supermarkets as well as at warehouse clubs and convenience stores, Moody's would include for this purpose all outlets that sell groceries. The rating agency also uses relatively broad category definitions for this purpose. All of apparel is one category, for example, assumed to include department stores, shoe retailers, children's wear, and intimates. The analysis of market dominance is affected by the degree of market concentration, so that a leading retailer in a highly concentrated market will score higher than a leading retailer in a highly fragmented market. The diagram appearing now illustrates how the combination of market concentration and company presence lead to the approximate rating for this subfactor. We pause for a few seconds while you examine this diagram. And the table appearing now essentially summarizes the information from the preceding diagram in words, for those who prefer the verbal over the visual. Again, we pause for a few moments while you review its contents. The third rating subfactor in the scale category, company geographic presence, recognizes the diminished exposure to localized economic or natural and environmental conditions that comes with diversification and the differences in economic trends between regions. It also takes account of a retailer's profitability in any given location. Moody's regards geographic diversification as a positive factor in cases where the retailer has overcome the startup costs and risks of entering the market in question. The rating agency divides the globe into 5 geographic regions: North America, Latin America, Asia Pacific, Europe, and Middle East and Africa. And it considers both the breadth of geographic coverage and the extent to which a retailer's presence has meaningful pockets of concentration within its total coverage area. So a retailer operating in a single European country, but with full national coverage, would score better than one operating in a single European country, but with a presence in only 1 or 2 cities. And significant national coverage in a large economy or land mass will score higher than significant national coverage in a smaller and less diversified country. The US, which represents a large economy and a large land mass, is divided into multiple regions to create comparability between companies operating inside and outside the country. The table appearing now classifies the company's geographic presence into one of 8 broad rating categories from AAA to CA, based on relatively objective criteria regarding percentages of sales and number of stores per region, but also involving subjective judgments as to the materiality of a presence and whether it is, quote, significant or not in a certain region. Note also the bifurcation between US and non-US issuers. Again, we pause for a minute so you can examine the individual entries in this table. The third rating factor is execution ability, which you will recall includes 2 subfactors. First, a very qualitative and judgmental concept of quality of execution, and second, a quantitative measure of EBIT to average book capitalization. Execution ability aims to capture both the effectiveness of logistics behind the store and the face that the retailer presents to its customers. In sum, its ability to meet customer expectations. Retailers who are efficient and responsive to customer expectations typically benefit from higher revenue growth, which allows them to obtain better purchasing conditions they can pass on to customers, which feeds a virtuous circle of growth and profitability. Vulnerability in execution provides early warning signs of future overall credit deterioration and is eventually reflected in some of the preceding broad rating subfactors. The first subfactor, quality of execution, aims to dimension the company's ability to meet the target shopper's expectations through a combination, as we said earlier, of front-end and back-of-the-store operational qualities. These center around the so-called shopping experience, quote-unquote, and also on the company's supply chain. Much depends here on Moody's view of the strength and depth of management expertise and its capacity to anticipate market trends. Slippage in execution can have an immediate adverse impact on customer perception, on financial performance, and on credit quality. The rating agency weighs a large number of attributes here, including the following: the depth and history of supplier arrangements, and the extent to which these arrangements reflect a win-win relationship between the retailer and its suppliers. 2. The consistency with which the company's buyers are able to meet evolving consumer taste and preferences. 3. The consistency of the price and quality components of the offer. 4. The ability to judge and manage the product mix during key trading and ordering periods and during key sales periods, e.g., during holidays and the back-to-school season. 5. The ability to get product on store shelves, to manage through fast-changing consumer preferences and short fashion cycles, the so-called speed to market. 6. Evidence of meaningful inventory overhangs and markdowns affecting gross and operating margins. 7. The ability to produce like-for-like sales above relevant competitors. 8. How well invested the supply chain is and what incremental investments are required to mirror best-in-class retailers. 9. Running levels of merchandise availability compared to peers. 10. The degree to which a retailer can track a specific good throughout the entire supply chain, from order to sale inside the store. 11. Reliance on and degree of control over third-party operators as part of the supply chain, such as haulers specialized in logistics. 12. The extent to which management is able to maintain an offer that focuses on the fastest moving lines across its stock-keeping units. And finally, 13. The potential for merchandise obsolescence. Merchandising, referring generally to a retailer's ability to choose, purchase, and price goods appropriately, is a fundamental function for all retailers. Merchandising decisions are more prominent in specific segments, which are subject to more rapid changes in consumer preferences, such as apparel or electronics. Staples such as food are generally less volatile, yet food retailers do remain exposed to substantial shifts in consumer preferences, such as the need to accommodate ethnic, low-carb, and organic product lines. A retailer whose quality of execution is broadly in line with that of its home market peers will receive a BA for this subfactor from Moody's. Walmart, on the other hand, scored AA on this subfactor as of mid-2011, with Moody's finding its logistics the best of any retailer worldwide. The table appearing now classifies the company's quality of execution into one of 8 broad rating categories, as usual from AAA to CA, based on product offerings, shopping experience, ability to meet customers' expectations and anticipate industry trends, and whether the store's website and supply chain are of high quality and create a competitive advantage. As usual, we pause for a second while you examine this table in more detail. We can quickly dismiss the second subfactor, EBIT to average book capitalization, a very dry but objective measure of how efficiently the issuer utilizes the capital it employs in its business, including real estate, intangibles, and working capital. The denominator in this calculation is defined as book equity plus short and long-term debt plus long-term deferred taxes plus minority interests minus cash. The average level of this item is defined simply as half the sum of the beginning and ending measures for the 12-month period. The table appearing now classifies this measure into one of 8 broad rating categories, as usual from AAA to CA, and is self-explanatory. The last rating factor, financial ratios, includes 3 subfactors you may recall: debt to EBITDA, retained cash flow to net debt, and EBITDA to interest expense. Debt to EBITDA is an indication of the multiple which debt represents of the earnings before interest, taxes, depreciation, and amortization, and despite certain drawbacks, is a suitable measure for comparative purposes, particularly since it eliminates the impact of varying business models that drive different levels of depreciation and capital structure decisions that impact interest expense. We remind you in this context that Moody's adds to the reported debt figure an amount equal to 8 times the annualized operating lease payments, which it views as debt-like for analytical purposes, and makes a further adjustment based on the funded status of pension plans, an important consideration for retailers that may have huge labor forces. The second of these measures, RCF to debt, is defined as the ratio of funds from operations less dividends divided by debt. It is a good indicator of the company's financial flexibility because it measures how quickly debt could be repaid after current period fixed cash expenses, including dividends, are met. In addition, the absolute level of retained cash flow is an indicator of the company's ability to cover its working capital, maintenance capital expenditures, and investment spending needs. Here again, the reclassification of rental expense into an interest and principal component will affect this measure, as we will illustrate in Chapter 4. Finally, you should note that this metric is calculated on a net debt basis to account for those companies, principally in Europe and Asia, that maintain higher than average cash balances. The last subfactor, EBITDA to interest, is defined as the ratio of earnings before interest, taxes, and amortization to gross interest expense, and measures the borrower's ability to cover the cost of borrowed money. Yet again, this measure is affected by Moody's adjustments for operating leases, which treat 1/3 of the annual rent expense as interest and the other 2/3 as depreciation expense. The table appearing now converts each of these three ratios into one of the 8 broad rating categories as before, and is simple to apply. Having completed the determination of the individual ratings for each of the 9 subfactors, the remaining steps in the quantitative part of the credit analysis should be familiar. Step 1 is to combine the individual subfactor ratings with their individual weights to obtain an overall weighted average score for the company as a whole, again by means of the table you saw at the beginning of this chapter, reproduced here for convenience. We will illustrate how this works for Macy's and Walmart in detail in Chapter 4. All that remains is to reproduce the final table from Moody's 1, which converts the weighted average score into the overall rating, at least with regard to the purely quantitative part of the analysis. From this table, you may recall the presence of the numeric suffixes, enabling the rating agency to differentiate more finely than before within its 8 broad rating categories. Again, this will be illustrated in detail for Macy's and Walmart in Chapter 4. As we have mentioned, Moody's rated 109 retailers as of the date of the Moody's 1 document, with final senior unsecured ratings ranging from AA2 to CAA2. That document provides the individual subcategory ratings for 24 of these companies, some of which bear a little commentary. Moody's emphasizes that for the retail industry, in particular, qualitative factors, which include segment vulnerability, market concentration and company presence, and quality of execution, as well as off-grid rating considerations we will examine shortly, are highly important to retailers' credit ratings. several retailers have very different scores for qualitative factors and financial metrics, often balancing the safety of a stable market segment with relatively weaker credit metrics, or maintaining very modest leverage to cushion relatively high operating risk. The table appearing now lists in the first column the names of the individual retailers with their senior unsecured rating appearing at the top of the second column and throughout, and the last column showing the individual ratings for the business and cash flow volatility category. Moody's comments especially on so-called outliers, defined by the rating agency to mean sub-factor ratings that are 2 or more grades higher or lower than the entity's overall rating. Most outliers for this factor are positive. Claire Stores and Rite Aid are examples of strategic decisions to add high financial leverage to companies with relatively stable business profiles. The 2 negative outliers, Lowe's and Nordstrom, are exposed to fluctuations from economic cycles, but maintain reasonably strong financial positions to cushion cyclicality. These observations we just made are summarized here for your convenience. Market presence, which is the second factor, captures scale, concentration, and geographic diversity. Claire Store and Rite Aid are notable positive outliers in which scale or a well-diversified presence throughout the US is offset by weak financial metrics, as you will see in a few slides. Kroger and Metro are positive outliers on scale, but Kroger is a negative outlier on geographic diversity because it operates solely in the US and has regional concentration within it. Nordstrom's single B scores on market concentration and geographic presence reflect high fragmentation in the apparel market and its sizable concentration in California. Again, these observations are summarized on this slide for your convenience. In factor 3, quality of execution tends to be a positive outlier for most retailers. Retailing is a fragmented industry with many unrated small players. Rated retailers, almost by definition, have scale and infrastructure, which provide advantages over the majority of competitors, resulting in relatively high scores for the subfactor. As expected, EBIT to average book capital, the second subfactor here, tends to be negatively correlated for more highly rated companies with stronger capital structures, since the stronger the capital base, the harder it is to earn a reasonable return on it. CARSA's AA score in this subfactor results in part from its credit business segment, which has been the principal earnings generator and, being funded in the securitization market, is relatively capital light. The last category, financial ratios, is rarely a positive outlier for these issuers. Costco, one of the few positive outliers on this list, benefits unusually from its $5.5 billion pile of cash and short-term investments, a meaningful portion of which is expected to be distributed to shareholders over the period 2011 to 2013. In contrast, The poor retained cash flow metric for Woolworths reflects its historically high payout ratio. These comments again are reproduced in the next two slides for your convenience. The negative outliers in this category tend to be highly rated companies with a strong national franchise or global presence, demonstrating how the benefits of good presence, execution, and relatively stable business performance can mitigate relatively weaker ratios. We complete this chapter by examining the other rating considerations cited by Moody's in the document Moody's 1, but not explicitly incorporated in the 9 subfactors we have been analyzing. Moody's acknowledges a trade-off between simplicity that enhances transparency and greater complexity that would enable its grids to map more closely to actual ratings. It also emphasizes that its ratings incorporate expectations for future performance, while the information used to illustrate the mapping process is mainly historical. Expectations for future performance may be based on non-public information obtained from senior management, or by extrapolating from past performance, industry trends, demand and price outlook, competitor actions, and other factors. These may turn out to be inaccurate as a result of unanticipated changes in the macroeconomic environment, including consumer spending and unemployment, general financial market conditions, industry competition, and regulatory actions. Important factors left out from the 9 rating subfactors include operating environment, operating model, extreme seasonality, liquidity and financial policy, and quality and experience of management. Physical, financial, or regulatory barriers to entry in a specific segment or geographic market create a significant competitive advantage for incumbent retailers. The cost of real estate investments could be prohibitively high for new or smaller players, as could be the cost of establishing distribution infrastructure and supply relationships. In general, barriers to entry such as planning restrictions are higher in Europe and Japan than in the Americas, offering a degree of protection to incumbents. A high level of regulation generally reduces competitive differences by constraining differences in pricing, advertising, or operational choices that retailers could otherwise use to differentiate themselves. Under a typical business model, retailers buy merchandise from suppliers, offer it for sale to consumers, and profit from the difference between the resale price and their purchase and operating costs. But some retailers, particularly some large ones in Japan, operate a consignment model as a risk reduction strategy. Under this model, suppliers rather than retailers assume the inventory risk, which reduces the retailer's profit margin but guarantees a steadier stream of less risky income. Variable rate leases may also reduce the risk of carrying fixed expenses on a variable revenue stream. And finally, returns may be enhanced through adjunct businesses, such as warranties or financial services, or by selling business licenses rather than directly investing in new stores, as for example Walmart has done in India. Virtually all retailers have some seasonality in their sales patterns, which affects profitability, working capital needs, and cash flow. Seasonality depends partly on the choice of the retailer's business, but reflects also the retailer's financial strategy in transacting with suppliers and customers. A retailer that exhibits extremely volatile seasonality compared to peers in its general segment is sometimes rated lower. Experiencing little or no seasonality is a positive rating factor, conversely. Liquidity can be extremely critical for retailers since operations cause large seasonal swings in cash collections. Weak liquidity, which may result from financial policy or from an unexpected interruption of normal inventory liquidation, magnifies default risk. The retail sector faces large swings in trade receivables and payables in relation to seasonal items. Liquidity concerns may cause vendor confidence to evaporate, causing a vicious circle that can quickly turn to crisis. Strategic and financial decisions also have a significant impact on future credit quality. Moody's acknowledges that risk-taking is an integral part of sound financial and strategic policies and measures risks against potential benefits and the ways those benefits flow to creditors. A reluctance or inability to grow or to invest in replacement assets while conserving cash in the short term may cause a company to become competitively disadvantaged over time. The balance between return of cash to various stakeholders is also a large element of financial policy. Measures to enhance shareholder returns, such as selective acquisitions, are not always detrimental to creditors, but debt-financed distributions to shareholders and distributions of excess cash which impair liquidity are of concern. Quality of management, finally, including corporate governance, is highly subjective and cannot be included in the grid without making it too complex. We listed earlier several of the criteria by which Moody's evaluates management. Moody's completes its report by listing a number of key rating issues over the intermediate term, quote unquote, which we summarize here briefly. Rising raw material prices. While these may be only cyclical, they could become a rating consideration if retailers are ultimately unable to pass on these increased costs. In partial mitigation of this reality, manufacturing hubs for many consumer goods that require meaningful labor have moved to lower cost jurisdictions, and retailers have invested in technology and supply chain initiatives that increase efficiencies and keep prices lower. Further cost reductions may be difficult, however, raising the specter of inflation in retail and potentially reducing demand. Technology will continue to drive an evolution in shopping habits, which could cause a strategic shift towards permanently reduced pricing rather than high/low promotional pricing. Smartphone applications will make consumers even more price savvy. Online sales are gaining increasing focus for many retailers in Europe, which had lagged the US in this respect. The impact on credit profiles is currently limited and difficult to assess since the online channel remains relatively small, but it may have greater impact on metrics and credit profile going forward and may start impacting overall profitability and market presence. An aging US population, with the proportion of consumers aged 65 and older expected to grow throughout the medium term. This will lead to subtle shifts in retail spending, with older consumers spending relatively less on apparel, home furnishings, home improvements, and so on, than younger ones, and spending more on prescription drugs, vitamins, health, wellness, travel, and leisure. Weak public finances in Europe may have consequences for government spending and taxes, for public sector employment, for house prices, and for bank lending, all of which can negatively impact consumer confidence. Moody's does not rate any retailer in any of the most troubled European countries, but a number of the rated ones have a presence in those countries and have reported more difficult conditions there. In China, execution capability will be critical to capture growing consumer spending across provinces. Overly aggressive expansion plans could result in mounting debt while cash flow could fluctuate. The ability to balance financial flexibility, including the management of the debt maturity profile and liquidity for expansion, against the need to grow and capture market share, will be critical. Japanese retailers, finally, are challenged to maintain like-for-like sales in the mature and fragmented industry, particularly given the declining population. As with China, maintaining a balance between growth and improvements in financial leverage is essential. This completes Chapter 2, as well as Part 1 of this module.